Hello and welcome to this presentation. I did this presentation over this weekend, last Sunday, for our PMS clients, and I thought let me record this because this has a number of relevant points uh, when we discuss how the economy is looking like, what the markets are looking like, and an overview of my investment philosophy and how it has evolved over the period. So without much ado, let me quickly go through. So first of all, my investment philosophy, I've captured it in very short points. And the first and most important part of what I do and the way I've always thought is we need to be able to reduce the possibility of permanent capital loss. And to me, that is very important for somebody who started with practically nothing. I started investing with 5,000 rupees with my first salary, and no inherited wealth, nothing. So from there, when you start your journey, what is important is that you tend to give a lot of value to the capital that you have. And over the years, what I've seen is, you know, if you are able to restrict yourself from not buying companies which go bankrupt or fall in price with 80-90%, you will end out okay. I mean, if you have a reasonably diversified basket of 10-20 stocks, you'll end up okay because unless you are completely off the mark, you'll at least have a few good stocks which will compound over the time, and you'll end up with a decent result. You may not be the best performing CAGR that you can think of, but at least you will not sort of lose money and get out of the market, which a large number of people do. So the first and most important thing for me is to avoid buying bad companies. How we define bad companies, etc. I'll not get into the depths of it, but I think if you use a little bit of common sense, most investors would know uh, which companies are not that good, right? So just study the history of the management, study the history of the business, and you'll get an idea. And the other thing that I've used and I've talked about it very frequently is, irrespective of the type of investment that I do, whether it is long term, short term, quant, trades, whatever, I use stop losses. Because my theory is that there are a lot of things which influence the market, which is beyond my control, which is even beyond my comprehension. So if I have to protect my capital, no matter what, I have to be able to have a mechanism where I get out if things are going against me. So, that is one of my major, realizations over the last 25, 20, 23 years that I've been investing. The next is that I always tend to invest with a long term horizon, even when I am doing short cycle trades. By that, what I mean is my investment horizon, my portfolio is long term. So I put in money in my portfolio and I don't take it out unless there is an emergency or I really need the money. So, for example, in the last 23 years, I have never taken out money from my equity portfolio because when I was working full time, I had a salary to support myself and my family, and uh, so that part is very important. So especially for people who are not full time investors, it is very important to have uh, a portfolio view which is 10 years, 20 years, 30 years, and then inside the portfolio you could have stocks which have a much shorter duration. You're playing cycles, you're playing, even if they are long cycles, typically hold for 2, 3, 4, 5 years, as long as the business continues to perform. So basically, having a long-term horizon, what it does essentially is it sort of tends to insulate you from day-to-day gyration. So I'm recording this today on the 10th of October, and yesterday, day before, over the weekend, we saw the war break out between Israel and uh, Hamas, and yesterday the markets were down. Now I'm sure that unless this situation escalates a lot, 6 months down the line, people will not even remember that something like this happened. But in the heat of the moment, when the markets are going down 2 3 percent, and the stocks that you hold are going down, unless you have a long term horizon, it it tends to mess with the your tends to mess with your mind. The third point is, I'm looking at focused fund management. I'm looking at you know active portfolio management. I have always shunned away from indexes. uh, you know and that is why one of the reasons why I have stopped investing in mutual funds is most mutual funds act as quasi index funds, because the fear for most fund managers of not being able to outperform the index makes them hug the index, right? So if you look at a typical mutual fund construction of their portfolio, what you will see is that uh, let's say Nifty has, just as an example, say 35% of financials. So what typically tends to happen is a mutual fund will construct its portfolio and say, okay, if Nifty has 35% of financials, let me have between 32 and 37 or 30 38. So that is the leeway that they have. But irrespective of the fact whether they like financials, the prospects over the next 2 3 years or not, they will be forced to buy it, because if they don't, and if they are wrong, they will underperform the index severely and then get penalized for it. So, as an individual investor, as a small fund, we have no compulsion of hugging the index. We have stocks which have nothing to do with the index. In fact, most of our stocks are not in the larger indices. Uh, Even if they are sometimes, they will not be very large weightages. So I think that is a very important distinction to make, is that your investment has to be driven uh, based on fundamentals, based on quantitative parameters, or whatever strategy that you follow, and not try to mimic an index. The next important thing that I've sort of done or graduated to is being completely market cap agnostic. So when people talk about small caps, mid caps, large caps, it doesn't make any difference to me. My theory is, I am looking for businesses which is going to do well over the next business cycle. And if that is the case, how does it matter whether it's a small cap or a large cap or a mid cap? Now, historically, if you crunch the numbers, you will see probably that mid caps and small caps have done better than large caps. But it is not that large caps have not given great returns. So it is a factor of when you are buying, what you are buying, and understanding what you are buying. So, having a open mind about market cap, I think, is very, very crucial to investing. The next point is that, and this is the next point about not knowing everything about an investment, is sort of again tied back to my use of stop losses and capital protection and risk management. So once you acknowledge to yourself that uh, there is things that can happen in the market, whether it is market related risk, like suddenly you have a Israel Hamas war, you have a Russia Ukraine war, something goes wrong somewhere, and you have a company specific, industry specific challenge or problem. Some factory, there's a fire in a chemical factory, or there's an earthquake in a place where the company operates out of, or there's a flood, like what we saw in, I think, Bandhan Bank a few years back. There was a flood in Assam which impacted the business significantly. So there are a lot of things which can happen, which is very difficult to uh, envisage before the event happens, and that is one of the reasons why you always need to be a little bit conservative, a little bit skeptical, and always thinking about managing risk of the portfolio. Right? And lastly, I think this has been the addition that I've made to myself over the last 5 6 years. And to my knowledge, I think we are the only people in India right now who sort of follow this strategy, which is a multi-strategy portfolio. We are not value investors, we're not growth investors, we're not momentum investors, we're not XYZ, any XYZ investors. We look at markets from a top down and bottom up approach. We do multi strategy, multi factor investing. So in our portfolios, you'll find value, you'll find growth, you'll find momentum, and you'll find that we move from one strategy to the other based on an overall allocation policy, and see how and move to areas where the strategy is becoming dominant. And this is something which is very important to understand, is because no one strategy will outperform all the time, right? Value investing goes through very long, deep periods of slumber when it doesn't do anything. Similar for growth, similar for momentum, similar for qualities. Whatever factor that you think about, there will be times which will take years, or maybe quarters, months, years, when it will not perform, and it will test your patience. So the way of our thought process has evolved is we look at the dominant, we look at multiple strategies together, and we allocate slightly more to the dominant strategy. And what that does is we are able to have a much more smoother equity curve. Our portfolio returns get to be slightly smoother and more, probably a little bit more consistent over time, compared to just following one strategy, right? So these are the basic 5 6 points that I have evolved over the period as my investment philosophy, and none of these are written in stone. As I keep evolving as an investor, these will also keep evolving along with me. Now, very briefly, let me talk about the two funds that we have in the PMS offering, Sri managers. The first one is Shree Lakshmi. As the name suggests, Lakshmi is the goddess of wealth, and the whole idea of this fund is that this is the wealth creator in your scheme of allocation of things. This is where I have a top down and bottom up approach. What I mean is, we look at industries which are doing well, we look at individual stocks which are doing well, and we try to sort of have a marriage of them, and look at stocks which are in the sweet spot. Have a core and satellite approach. We typically have 15 to 20 stocks, out of which maybe 7 8 would be core, and others would be a little bit more of the satellite kind of stocks. The satellite stocks will have slightly higher churn, in the sense that we might get in, get out, based on the cycle of the business. And the core stocks tend to be there in the portfolio for a much longer period. Again, we look for stocks in a completely market cap agnostic way, and the typical holding period is between 1 to 3 years, or as long as the business cycle lasts. So that is the guideline that we have for ourselves when we look for stocks in this portfolio. So this is a typical or classical buy and hold and monitor for a business cycle kind of a portfolio with reasonably less churn. The second and the other fund that I have is the Shree Vriddhi fund. Again, as the name suggests, Vriddhi means growth. It means speed, velocity. So here we are more looking at slightly higher churn. We are looking at trying to capture short cycles, things which maybe in vogue, flavor of the season kind of thing, where we can catch a short, sharp up move in the markets. So for this, we use our proprietary quant models, our technofunda kind of approach, and the portfolio is also more concentrated. It's 10 to 12 stocks with very well-defined stop losses. So strict risk management in place. And here again, we are looking at market cap agnostic plays. We're looking at typically between 2 to 6 months of horizon of holding period. The first half of this year we've just completed in the end of the month of September. Both the funds have done well. Shree Lakshmi has returned, I think, around 35.8 cents, so 36%. Vriddhi has done about 43 and a half, 44%. So both the funds have done well. Uh, Having said that, let me also be very clear and reiterate that this kind of outperformance is not normal, right? Sort of double the benchmark is not a normal process. One should not expect this to keep repeating. And with that, let me also just take you through the annual returns of the S&P 500 index. So I typically try to talk about S&P 500 or the Nifty 50 most of the time because they capture at least the large part of the market. And when you look at I mean Nifty 500 and you look at the returns on a calendar year basis, what you will see is that returns in equity markets are very very lumpy. So you will have years of where you get 97% returns, and you'll have years where in the global financial crisis 2008, CNX Nifty 500 was down 57%, right? So this will happen in general. My observation is, if you take any batch of 5 years, it's reasonable to expect that in those 5 years, one year you will have a loss, 2 years you will have probably very moderate gains, or borderline loss to moderate gains, and 2 years you'll have relatively good returns. And if you again look at the last 5 years in this chart here, 2018 to 2022, it is a absolute copybook case of what I am speaking about. So 2018 you had minus 3.5%, so 1 year of losses. 2019 and 2022 were 2 years of moderate gains between 7.83% to around 7.5%. And then 2020 and 2021 were two good years where you had returns of between 16 to 30%. So exactly this is the pattern that I have seen which keeps repeating. The only challenge with this is that you don't know the order of the occurrence of these returns. So uh, you will not see or rather you do not know when the year of high returns will come, when it will be the 2000 year of 2003 or the year of 2007. Having said that, the other important thing to remember is, whenever you have multi-year bull market where you have many years of very high returns, like we saw from 2003 to 2007, that is a time when you need to be really really careful, right? Because that is something which is non-sustainable over a long period of time. So the takeaway from this particular slide is that last few last 6 months returns have been good. Overall market returns have been good. 6 months 20% returns by the BSE 500 is actually phenomenal. Our funds have performed much better than that, but it is not normal to expect this kind of return over a long period of time. uh, Ultimately we will be performing, or rather my expectation is that we will be able to generate reasonable returns, and my endeavor is to limit the drawdowns as much as possible. That is where my primary focus remains. I'm happy to forego a little bit of returns in search of reducing large drawdowns. Now let me shift over to the economy and how we are placed today. So if you look at what we are seeing around us, the government, both the central governments and the state governments, are trying to do a lot in terms of pushing the economy. And if you look at the measures that is being taken over the last 2 3 years, the PLI schemes, the corporate tax cuts, the focus on infrastructure in terms of railways, in terms of defense, in terms of airports. highways. These have seen a lot of spending. Also, we are seeing a lot of discussion talks on helping set up semiconductor plants in India. These are areas which require large amounts of capital outlay. And lastly, there has been a fair amount of focus on the ease of doing business, and which is very important from creating the ecosystem for facilitating good business. So I think the governments, both state and central, are trying to boost the economy. Uh, the the budget, budgetary support, or the situation of budgets have improved uh, for both the central governments and states over the years, and things are looking interesting. So here is one chart uh, based on government spending and how we are seeing in growth that is coming through. So you see that central government capex is up, state government capex is going up. Household spending on property, real estate is beginning to pick up after a fairly practically a decade of underperformance by the real estate sector. Again, it is starting to pick up. Uh, just today morning, I was reading that uh, housing, I think real estate inventory is the lowest in the last decade. So things are getting better. Private sector capex funding is going up primarily, I think, because of two things. One is the PLI scheme intervention, and the second is a gradual shift of the China plus one thing playing out. So these are two important factors which are actually playing out. The China plus one theme, again, I have spoken about it multiple times before. It's something which is very it's going to play out over a long period of time. If you look at the development of China, it has taken nearly 25-30 years, and it will take nearly as long, or at least half of that time. So it will take 10-15 years for a large part of manufacturing base to move out of China to other geographies. And India is not going to be the primary winner in this migration. I think countries like Mexico, the US, a lot of smaller Western European countries, Vietnam, Indonesia, Malaysia, all of these countries are going to benefit, and India hopefully will also benefit as part of this cohort. Uh, so again, I already spoke a little bit about the focus area. So you look at infrastructure, corporate capex, these are areas where we are seeing some traction. Consumption, again, for India has always been a very dominant theme. Uh, right now, for the last 2-3 years, during the pandemic, I think we've seen a fair bit of challenge because the rural economy and the urban poor have suffered or struggled due to COVID and job losses and things like that. And and we are yet to see uh, that segment actually able to come out of it fully. Now, if you look at, say, the Manrega numbers, uh, if I remember correctly, I think first half of the entire year's budgetary allocation was, if I remember correctly, and I could be wrong, is about 60,000 crores. And halfway through the year, we are already in a deficit of roughly 6,500 odd crores. So we've spent the entire allocation and some more, which sort of gives an indication of rural income stress. Because for me, Manrega is denotes the sort of low cost earning scheme for the rural poor. And if they are taking up these jobs in more numbers, it means that other avenues of uh, income generation is has not yet picked up. Add to that, the unseasonal rains and impact of climate change that we are seeing all around us. Right now, we are sitting through the huge devastation that has happened in Sikkim over the last week. We've seen what has happened in Uttarakhand earlier this year. We've had flooding in large parts in large cities, unseasonal rains. So all of this is going to impact some amount of our cultivation, crops. And if you look at what happens in India, primarily the inflation is driven by only two factors: food inflation and fuel. And both of these are not in anybody's control, right? Excuse me. So food inflation, again, depends a lot on our you know rainfall and how the weather holds up, and obviously oil prices depends on global uncertainty and things like that. So no amount of monetary tweaks that the RBI can do is going to actually help inflation, in my opinion. It's the rate hikes and etc. that the central government, I mean the central bank does, is more a signaling mechanism to tame inflation, because the challenge is more on the supply side. Lastly, I think there is a lot of focus on new industries. We've seen how digital has taken over, or has sort of completely intruded our lives. Mobile phones, and how we are seeing today a lot of business models becoming digital first. We're seeing insurance companies, who are primarily app based. Uh, we've seen IPOs of companies like Zomato and PB FinTech, and hopefully over the next few years we'll see more of such startups coming to the capital markets, and expand the overall market base. So overall, there is a focus, there is a vibrancy that is there. India is definitely one of the most talked about countries, economies in the world. So I've been reading, say, in the Financial Times and Wall Street Journal for the last 5 6 years on a daily basis, and I don't remember when FT has sort of written every day about India. Nowadays, practically every day you will find one article about India in the Financial Times, and that just goes to show that globally, this is the newspaper or business paper that uh, the most decision makers around the world, business leaders, political leaders around the world read. So obviously, it means that India is taking up more and more mind share in the minds of people who drive the business world and the economic world around the globe. So that's a very encouraging thing. Now, uh, amidst all this, obviously, not everything is great. There are dark clouds on the horizon which we should not ignore. So I think the first couple I already spoke about. Then yesterday there was this announcement of the upcoming state elections. Next year we are going to see central elections which will come up. So elections tend to increase volatility in the markets. There's going to be a lot of noise, a lot of speculation around who's going to win, who's going to lose, what is going to be the impact. Uh, if you again look at the last, say, since 1991, broadly, so roughly about a period of 30, 33, 34 years, uh, the broad economic direction of any government which has come has not changed. So purely from a economic perspective, whichever government comes in any state or center, whichever form of government, whether it's a single party, multi-party, coalition, whatever, uh, I don't see that the economics of India is going to change drastically. Obviously, there is going to be short-term volatility, fear, exuberance based on the outcome of the elections. I personally don't, engage in forecasting of these kinds of events. What I tend to do is have a written down policy of how I will react if the market behaves in a certain way. So if whatever happens in any event, I will keep looking at the market and see how it performs, and then take a call based on a predetermined sort of stance that I will take. Then we have social and political challenges in India, across the world. Uh, Great example again, like I said this week, suddenly out of nowhere you have Israel and Hamas conflict. You have Russia Ukraine going on for pretty much now, more than a year and a half, roughly. And South China Sea is always in a bubble. I mean, in a boil. Something or the other is always happening there. So the world politically is in a flux, and you don't know where the next problem is going to come from. So that also can lead to sudden knee-jerk reactions in the markets. And of course, the next 2 points is what everybody is talking about consistently, constantly, since I think the last 1 year. It's the possibility of a prolonged slowdown or a recession in US, in Europe, China. Obviously, things are also not good, and the rise in oil prices. So again, these are things which are beyond our control. We need to, but unlike a lot of other people, I tend to believe that macro plays a very dominant role in businesses. So we cannot take the eye off the macros. We need to follow it. We need to understand the implications, and react based on what our views are of this. But these are things that we need to keep our eyes open for. The next is overview of the markets. The most common question that I've heard over the last few months is, markets are at an all-time high. Should we invest now? The interesting part is here is I've taken a log chart of Nifty from 1991 till date, uh, and if you look at it, you'll see all these points which are marked in blue are all-time highs, right? So an all-time high is just a statistic or a number, and it doesn't mean that it is the end of the story. It is basically a point. It's like a staircase, right? You take one step and then you take the next step. So from a journey from say 100 to 1000, you will have to go through 200, 300, 400, 500, and so on and so forth. So at every level it will be an all-time high. The difference is that if you think about bonds, right? If you think about say your fixed deposits, every day if you if you market to market, or if you just look at bond, FD returns, every day it is a new high. So do you go out and sell your fixed deposit, or go out and redeem your fixed deposit saying that नहीं नहीं ये तो मेरा all time high हो गया? You don't do that, right? So same for the markets. Like I said earlier, returns in the markets are non-linear. I mean, non-linear. It will not come in a straight line. It will go up, go down. That is the nature of the beast. And just as an example, I've given a breakup of how far we've gone from all-time highs of previous all-time highs. So the December 2003 all-time high that we had, we are roughly 1000% above from there, and so on and so forth, right? So uh, every time we go through a high, the next high is further away from that. So there's no you should not get afraid of all-time highs. It's just a, a step in the journey, right? So don't make your decisions based on where the market is. This is a very important slide, I think, of which basically tells us that the journey. If you look at the COVID lows, which is roughly May June of 2020, so roughly 3 years back, you will see that the market, say Nifty, has gone up has more than doubled. From 9,000, it is now roughly 9,000 19,500, and the PE of Nifty 3 years back was 22 times, and PE of Nifty is today also 22 times. Roughly. So the entire move, if you were 3 years back, you was thinking that Nifty PE is 22, let me sit aside. The P is still 22, and you've missed out on a 100% plus rally. So the important part here is to look at earnings growth. The entire move actually has been because of a large part of the growth has come from earnings growth. And if you look at this is the Nifty 500 or the Nifty pad growths, the numbers are actually quite good. Uh, Nifty over the last quarter, Nifty pad growth has been 32%. If you look at Nifty 500, the EBIT growth has been 35%. Operating profit has grown 32%. So uh, uh, every 3 out of 5 companies in Nifty 500 have given a revenue growth. Average revenue growth of all companies, top 500 companies in the country, have given a 10% revenue growth, right? So if you look at the overall scheme of things, the companies are delivering on earnings, and as long as the earnings uh, keep coming through, my guess is, or what history has taught me, is that markets will tend to remain expensive as long as earnings come through. And also the fact that we've probably cannot be 100% sure, but we are probably at the peak of the interest rate cycle, which again means that as and when the interest rates start moving downwards, uh, you will see a lot of easing of pressure from the P multiple. Like I said before, mid and small caps. Again, this is an illustration over the last 16 years. You'll see that 10 out of the last 16 years, a mid cap and small cap based portfolio would have outperformed a large cap based portfolio. That is only one takeaway from this chart. The other takeaway is that even if you are investing in large caps, or a combination of large caps and mid caps, or a combination of all caps, you would still really do well, right? If you look at the return profiles across the years, it's been really, really good. It beats staying away from the market. It beats pretty much any other thing, any other investment avenue, whether it is gold, whether it is real estate, whether it's anything. And my theory, I mean, this is why I have always invested in equities, is what I've always found is, who are the richest people around you, right? The richest people around you uh, across the world are people who run businesses. You don't find salaried employees or individual professionals at the top of the Fortune 500 list. You only find business people, or you might find one or two or a few investors, essentially people who are investing in other people's businesses. So as small investors, our job is also to piggyback on uh, other business people. So we have to, uh, for us to be able to create wealth, we need to partake in somebody's business if we are unable to run our own business. And even if we are running our own business, it makes sense to diversify away from the concentrated risk of running one business, and also partake in other people's businesses. I really like thinking, say, for example, if I am invested in, say, a Reliance Industries, just as an example, that I like to think that even if I am a 0.00001% shareholder of Reliance Industries, it is Mukesh Ambani who's toiling very hard from morning till night. He's working to generate wealth for me, and that is the kind of thought process and mental framework that we need to develop when we are investing in the equity markets. And this is the a very interesting slide. This is a study that Goldman Sachs has done very recently, which says that India is a country which has been able to generate the most multi-baggers since 2000. And this is something that I think most of us have also intuitively seen. We've seen businesses or stocks which have given extremely good returns over a 5-10 year period, and I continue to believe that in a growing economy, the next 10 to 15 to 20 years are going to give us more such opportunities to big stocks or big businesses which are going to be extremely highly remunerative and wealth creating for us. So, to summarize, the volatility that we see is a feature of the equity market. It's not a part, right? It is something that we need to expect and embrace. Very importantly, when you are at an all-time high, it is not a reason to be away from the market. It is very, very difficult to time entries and exit into the market. It is better to have a simple rule-based strategy of portfolio allocation. The point I'm trying to make is that don't base your decision on thinking that market is at an all-time high today at 19,500 Nifty, uh, and let it fall to X level, and then I will invest. What will you do if it doesn't fall to that level and if it goes up 20% from here? Right? At some point in our lifetimes, we'll see Nifty at 50,000. Right? It's just that it is not going to go up in a linear fashion. It's not going to go up every day for the next 10, 15, 20 years. It's going to go up, it's going to come down. But over the next 15, 20 years, we're going to see much, much higher levels. And uh, as investors in a growing economy with the industry and economic tailwind behind us, it is an offense not to participate in it and reap the benefits. And like I said, India is one of the best performing countries in the world. It is on everybody's radar. All countries, all economies, all businesses are thinking about an India strategy. So India is one of the most happening places, and you don't want to be away from the Indian markets. Uh, and just focusing that the focus that the government today has on infrastructure uh, led development, I think that is opening up years of sustainable growth for other businesses as well, and overall improvement of the quality of life and businesses in India. And lastly, I think it's very, very important that if you have, if so, first of all, you need to have a 5+ year time horizon if you're getting into equity markets, and you need to remain invested over a extended period of time, go through the ups and downs of the market, and embrace the wealth creation opportunity that we have got. Being Indians, being part of one of the most booming economies of the world today. So with that, I think that is the end. You can always reach out to me on Twitter and LinkedIn. These are the two social media which I'm mostly on. Uh, you can always email me. I'm pretty good with email, unless you're asking me for stock tips, which I will obviously ignore. Uh, but definitely, Twitter and LinkedIn is where I'm fairly, you know, fairly available and respond quickly. And lastly, I think disclaimers. All the data that we've used and continue to use are from public sources. All the data, whatever we talk about, is related to you know is in the public domain, and we run a SEBI registered PMS. And obviously, the last part is very important. Past performance should not be taken as an indication or guarantee of future performance. Uh, and essentially, just one liner in terms of disclaimers, disclosures. All disclosures in the world basically talk about one point, which remains unsaid, which is that if you trust what I am saying, if you believe what I am saying, then essentially it is your problem, right? Nobody says that upfront, but that is what all disclaimers, disclosures mean. Uh, you know, with this, I think I've sort of come to the end. Thank you all for taking out the time and listening to this. Do reach out if you have any questions, comments, and feedback.